From the outside, many people assume that businesses stay profitable simply by increasing their sales year after year. But that's not the real driver of long-term success. Profitability is actually a result of disciplined decision-making. It's about where capital is deployed, which operations stay open, and which operations must be closed. Ultimately, leadership must decide where every dollar can earn the highest possible return for the company. To see how this works in practice, let's look at two very different industries: restaurant chains and manufacturing companies. In a large restaurant chain, executive leadership, including the CFO, COO, and operational managers, meet regularly. They aren't just looking at top-line revenue, they are ranking every single location by its EBITDA margin. EBITDA is essentially a proxy for operating cash flow. It shows if a location generates profit before accounting adjustments. If a restaurant produces negative EBITDA, it is consuming the company's cash instead of generating it for the future. Now here is the key insight that separates good managers from great ones. Let's look at the cost of capital. Let's assume the company can borrow money at 4.5%. If a unit generates negative 7% EBITDA, you have a problem. Keeping that unit open destroys more value for the business than borrowing money to build a brand new one elsewhere. So executives ask, why keep a unit losing 7% annually when we can close it and redeploy that capital? Restaurants are highly sensitive to demographics. Sometimes the problem isn't operations, it is simply geography. Income levels, traffic patterns, and local competition can change over time, making once great locations obsolete. Leadership closes low-performing units and reinvests in better locations. That is capital reallocation in action. This process of closing the weak and opening the strong is often called creative destruction within a company. It may look drastic to outsiders, but it is a strategic necessity to protect long-term cash flow and shareholder value. Now let's shift to the manufacturing sector. The principle remains identical, but the focus of analysis changes. Instead of physical locations, we analyze individual assembly lines, product families, and customer contracts. Every single one of these elements must justify the capital and management attention invested into them. Low margin or negative margin products are dangerous. They consume labor hours and valuable machine capacity. If a product generates a negative contribution margin, it is actively destroying the company's value every day. When faced with these underperformers, executives must go through a rigorous evaluation process. They ask, can we raise the price? Can we improve operational efficiency to bring margins back into the green? Or should we outsource production to someone cheaper? Or perhaps just discontinue the product entirely? The reason for this discipline is simple. Capital is scarce. Capacity is scarce. And most importantly, time is scarce. Every single dollar invested in the business must be positioned to outperform the company's cost of capital. This is the core financial principle. A business remains profitable by ensuring ROIC is greater than its cost of capital. If borrowing costs 4.5%, but an asset only generates 2%, you are technically underperforming your required return. It's not emotional, it's mathematical. This principle isn't just for restaurants or factories. It applies to retail, services, construction, and tech. Any business that manages assets must have the discipline to prune those assets when they stop performing. So, what happens to companies that fail to maintain this discipline? They often face a slow, painful decline. Companies that fail to close weak units begin to carry chronic losses that drain their overall cash flow. This increases their debt burden and reduces their capacity to invest in new, high-growth opportunities. Without the courage to prune underperformers, even the largest companies can eventually collapse under their own weight. In contrast, strong companies are constantly evaluating. They see pruning as a necessary part of growth. Profitability isn't something you achieve once. It is something you maintain through constant, cold evaluation. To summarize, stay profitable by measuring EBITDA by unit and ranking your assets by real performance. Have the courage to close underperformers and reallocate that precious capital to stronger opportunities. And always ensure that your return on invested capital exceeds your total cost of capital. Profitability is protected through disciplined capital allocation. I'm your host from the CFO Suite. Thank you for watching this deep dive into strategic financial discipline. Visit us at www.thecfosuite.com.